First step is understanding management and ownership. Before performing any research on a stock, you want to answer some key questions regarding the company's management and ownership. Is the company run still by its founders? I personally like to invest in companies that are founder-led and got skin in the game. Consider high personal ownership by a founder as a plus and low ownership as a potential red flags. Shareholder return will be best served when the people running the company have stake in the performance of the stock. You can find this information on the company's website or in its exchange and security filings. Also look to see what amount of the float is held by institutions. Institutional ownership percentage indicate how much analyst coverage you get as a company. In the second step in my research, I look at the company total market capitalization. What is the company worth today? You find this by calculating the share price with the number of shares outstanding. At this step in performing my stock research, I'm not making any judgments regarding the stock. My focus is to understand what's the company's worth and the total addressable market they're playing in. For example, in the case of Tesla, their market cap is roughly $670 billion, and the total addressable market they're playing is worth more than $10 trillion. Some of the opportunities that include are the auto market, the solar production and storage, ride-sharing market, battery pack distribution, and self-driving car revenue. But the company market cap doesn't give you the full picture. When you start to examine the revenue and profit figures, the information you gathered about the company market cap starts to paint a clearer picture. Next, we'll look at company's financial metrics. When you start looking at financial numbers relating to the company you're researching, it may be best to start with the revenue, profit, and margin trends. A lot of this information can be easily looked up in the financial information sites. These sites provide historical charts showing how the company's share price fluctuations over time. Plus, they'll give you the price to sales ratio and price to earnings ratio. You should also review profit margins to see how the company is performing over time. You can find the specific information regarding the profit margins by going directly to the company's website and searching the investor relations section for the quarterly and annual statements. Next, we'll look at the competition and the industries it's playing in. Now that you have a feel for how big the company is and how much money it earns, it's time to size up the industries it operates in and with whom it competes. Compare the margins of 2 or 3 of this competition. You can find this information about the company's competitors on most major stock research sites. This gives you how the company you're researching is performing against the competition in terms of profit and in terms of margin. Next, we'll look at company's valuation. Now it's time to get into the nitty-gritty of performing due diligence on a stock. I look at PE ratios, which inform you about a company valuation. The share price of a stock tells you how much people are willing to pay to own the shares, but the PE ratio tells you whether the price accurately reflects the company's earning potential and or its value over time. Along with these differences, you should have a general sense of how profitable the company is. It's generally a good idea to examine a few years of net earning figures to give you a sense of company's earnings over a period of time. I like to use PE ratios in combination with other metrics such as price to book, the enterprise multiple, the price to sales ratio. Finally, the PEG ratio brings into account the expectations for future earning growth and how it compares to the current earnings multiple. Next, we'll look at the balance sheet. By reviewing the company's balance sheet, you'll see the level of assets and liabilities. Paying special attention to the cash levels, the ability to pay the short-term liabilities, and the amount of long-term debt held by the company. A lot of debt is not necessarily a bad thing and depends more on the company business model than anything else. Some companies are very capital intensive, example, oil and mining companies, while others need little more than employees, equipment, and an idea to get up and running, example, Facebook and Google. If the balance sheet numbers of total assets, total liabilities, and stockholder equity change considerably from one year to the next, try to understand why. By reading the financial statements and the management decisions in the quarterly and annual reports will give you some light on the situation. The company should be preparing for a new product launch, accumulating retained earnings, or simply shaving away at the precious capital resources. what you see should start to have some deeper perspective after having reviewed the recent profit trends. Next, we'll look at expectations and risks. In this step, you want to find out what the market expects of revenue and profit estimates over the next 2 to 3 years, and any long-term trends affecting the industries, and the company-specific details about the partnership, joint ventures, intellectual property, and any new product or services launches. And in terms of risks, make sure to understand both the industry-wide risks and the company-specific ones. Are there any outstanding legal or regulatory matters? What kind of long-term risks could result from it embracing or not embracing the green incentives? Investors should always keep a healthy picture of their worst-case scenarios and their potential outcome on a stock. Thanks for watching. Please write in the comment below what kind of stock analysis you guys do before you buy a stock. As always, have a great day.